All right, let's talk about ICL Group. They just made a huge, and I mean huge, move that's got everyone talking. They're essentially saying goodbye to the whole EV hype train and are doubling down on what they do best. So what does this actually mean for the company, and maybe for you? Let's break it all down.
Okay, so here's the plan. First, we'll dig into this really mixed quarter and why the market reacted the way it did. Then, we'll get into the main event, this big strategic pivot. After that, we'll slice and dice the numbers by division. I'll give you our official rating for the next call, and we'll finish up with a pretty interesting trade idea.
All right, first up, the quarter itself. And honestly, it was a bit of a head-scratcher. You've got ICL beating on earnings, which you'd think is great, but then they miss on revenue. Investors were kind of left scratching their heads, and the stock, well, it took a hit. Let's figure out why.
So you look at the headline numbers, right? Adjusted EPS comes in at 10 cents a share. That's a beat of about 5%. Good news. But then you look at revenue, $1.85 billion. That's a miss by about 6%. Not so good news. And when you have that kind of split decision, the market gets, well, it gets pretty jittery.
And here's the result. The market spoke, and it wasn't happy. The stock dropped 2.8% on the day of the call. So what gives? Why the sell-off despite the earnings beat? The real story, as it often is buried a little deeper than just these two numbers.
Okay, let's zoom out and look at the year-over-year picture. On the surface, things look pretty solid. Sales are up almost 6%, adjusted EBITDA is up 4%. Respectable, right? But, and there's always a but, the devil's in the details. Adjusted EPS was actually down 9% from last year, and gross margins got squeezed by a full point. So while the balance sheet looks fine, leverage is stable, that pressure on margins and profits is exactly the kind of thing that makes investors nervous.
But you know what? The quarterly numbers, they weren't even the biggest story here, not by a long shot. The real bombshell from this call was management basically drawing a line in the sand. They announced a massive strategic pivot. They're getting out of the EV hype game and going all in on their core bread-and-butter businesses.
And you heard it straight from the CEO, Arnon Aharansan. He said, "We will expand in the markets that are within our core and extract value from the markets where we are already leaders." This isn't them throwing in the towel. It's the opposite. It's about being incredibly smart and disciplined with their capital, putting it to work where they know they have a right to win.
So you gotta ask, why the big U-turn? I mean, ICL was all set to jump into the LFP battery market. You know, lithium iron phosphate, that's the hot stuff for EV cathodes. But then, reality hit. They lost out on some key US government funding for their St. Louis project. Similar funding in Europe just wasn't materializing. On top of that, the whole EV market is looking a lot weaker than expected. So they looked at the landscape and said, you know what, this is too risky. Instead of chasing a speculative dream, they're funneling all that investment back into the businesses they know inside and out.
So where's all that money going instead? Well, they're calling them their new growth engines. First up is specialty crop nutrition. We're talking about a market that's growing at 6% a year and is expected to be worth over $45 billion by 2030. The second engine? Specialty food solutions. Here, they're taking their deep knowledge of phosphates and aiming for a piece of the absolutely enormous $150 billion food ingredients market. See the shift? They're moving away from chasing a hot story to focusing on dominating huge, profitable, and established industries. And to make sure their foundation is rock solid while they do this, they've also secured a memorandum of understanding with the State of Israel for their Dead Sea operations. Now, this is a really big deal. Why? Because the Dead Sea is the heart of their operations. It's where they get their potash and bromine, which are cash cows for them. This deal gives them long-term clarity and stability, which is exactly what you want when you're embarking on a new growth strategy.
Okay, so that's the big picture strategy. Now, let's get into the nitty-gritty and see how each part of the business actually performed this quarter. This is where the story gets really interesting.
And wow, what a tale of two companies. On one side, you have the Potash division, just absolutely crushing it. Sales up 16%, and get this, EBITDA was up a staggering 41% year over year. That's all thanks to really strong pricing. But then, you look at the other side of the coin, Growing Solutions. Sales were up a little, but their EBITDA just fell off a cliff, down 22%. Yeah, this chart just says it all, doesn't it? Look at that huge green bar for Potash at plus 41%, and then that ugly red bar for Growing Solutions at minus 22%. It's a massive divergence. So what happened? A lot of it came down to weakness in Brazil. Basically, farmers there were getting squeezed and couldn't afford ICL's higher-end products. And you know what? This kind of volatility is exactly what management is trying to get away from with this big strategic pivot.
So, where do we go from here? What does all this mean for the stock going forward? It's time for our next call segment, where we lay out the bull case, the bear case, and give you our final rating.
Okay, let's start with the bull case. What could go right for ICL? Well, first, finalizing that Dead Sea concession would be a huge de-risking event. Second, if they can make some smart, well-priced acquisitions in crop nutrition and food solutions, that could really juice their growth. Third, potash prices are key. They're still strong, up 19% year over year. If that holds, it's a massive cash flow generator. And finally, if things turn around in Brazil, that would be a very welcome tailwind.
Now for the bear case, the things that could go wrong. Raw material costs are a big one, especially sulfur, and that could keep squeezing margins. Then there's pure execution risk. It's one thing to announce a new strategy, it's another thing to actually pull it off. The problems in Brazil could easily persist, and let's be honest, the market might just decide it doesn't like this story. It might punish ICL for walking away from the sexy EV growth narrative. Alright, so after weighing both sides, the bull case and the bear case, we're landing on a market perform rating for ICL. Look, the pivot to the core business is logical, it's prudent, we get it. But the risks, especially on the execution front, are very real. For now, we expect the stock to pretty much track the broader market until management can prove this new strategy is actually working.
All right, last but not least, let's talk about how you might actually trade this. We've got what we're calling an outrageous but plausible play, built directly off this analysis.
So think about it. How do you play a company that just stood up and said, we're choosing stability over speculation? Well, you lean right into that theme. You trade the theme itself.
Here's the idea, a pairs trade. It's pretty straightforward. Step 1, the thesis. The market is eventually going to reward ICL's discipline and punish the cash-burning EV plays. Step 2, the trade. You go long ICL, betting on that pivot to its stable core business. And step 3, the hedge. At the same time, you go short a basket of those high-flying, not yet profitable battery material stocks. You're basically betting on ICL's strategy being the right one. It's a pure play on stability, winning out over speculation. Which really makes you wonder, right? In a market obsessed with the next big thing, could the smartest move be to bet against the hype?
And just as a reminder, this is not financial advice.